Hi everybody, welcome back to our discussion of Chapter 10. In this video we'll talk about retirement of bonds. Bonds can be either retired at maturity or they can be retired before the maturity date. If bonds are retired at maturity, the company simply pays the par value to the bondholders. Any premium or discount recognized upon issuance of the bond should be fully amortized and have a zero book balance by the maturity date. Accordingly, the only bond-related account left on the books by the maturity date is bonds payable, and the balance in the bonds payable account should be equal to the par value of the bond. Therefore, the required journal entry is debit bonds payable and credit cash. If the bonds are retired before the maturity date, it's usually done either by purchasing the bonds on the open stock market or exercising a call option. A call option cannot be a surprise. It had to have been part of the original bond contract. A call option allows the bond issuer to pay off the bond before the maturity date, and it usually requires payment of the par value plus a little extra, and that little extra is called a call premium. If a bond is retired before the maturity date, a gain will be recognized if the carrying value of the bond is greater than the retirement price, and a loss will be recognized if the carrying value of the bond is less than the retirement price. Let's look at an example. Callable bonds with a par value of $100,000 were originally issued several years ago. The call option requires the issuer to pay a call premium of $3,000 to bondholders in addition to the par value. On the date the bonds are called, the bonds have a carrying value of $106,500. The issuer calls the bonds and pays $103,000 to the bondholders. Let's talk about this carrying value and what it means. If a bond is issued at a discount, the discount is recorded as a debit and bonds payable is recorded as a credit, and the carrying value is the par value minus the unamortized discount. In other words, one has a credit balance, one has a debit balance. You have to subtract the two to calculate the carrying value. But if a bond is issued at a premium, the premium has a credit balance and the par value has a credit balance in bonds payable. So the carrying value of a bond issued at a premium is the credit balance in the credit unamortized balance in the premium account and the bonds payable liability account added together. Therefore, we can see that this bond was originally issued at a premium because the carrying value is greater than the par value of the bond. So we can determine that on the books, there is a credit balance in the bonds payable account, and there's a credit balance in the premium on bonds payable account for $6,500. And together, added together, they equal the carrying value of the bond. So the first thing we're going to need to do is to calculate a gain or loss. And that is calculated as the $106,500 carrying value minus the $103,000 paid. And we will recognize a gain if the carrying value is greater than the retirement price. So the carrying value of $106,500 minus the cash paid, which is also the carrying price, the retirement price of $103,000 equals a gain on retirement of bond of $3,500. We now have all the pieces we need to record the journal entry to retire the bond. We need to debit the liability account bonds payable for the par value of the bond, and that will zero out that account balance. We need to debit the premium on bonds payable account for the $6,500 left in that account, and that will zero out that account balance. We need to credit gain on retirement of bond, which is an income account, and we need to credit cash for the $103,000 we paid to the bondholders. Well, that's all for this video. See you next time.